Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for Tuesday, August 22nd, 2023. What I'm going to do in this one is, as usual, start out with the equity markets and just very briefly, more so reiterate my long-term outlook, intermediate to longer term, by looking at the long-term charts and then kind of near-term stuff, which I've been focusing on a lot lately. But every now and then I kind of loop in the long-term because that formulates a bigger picture. Touch on the market leading stocks real quick, especially NVDA, because that one reports tomorrow, and that's been a big one, poster child for the AI hype bubble, whatever you want to call it. I want to do an update also on the financials, XLF and the banks. Treasury bond yields, just talk on that again. Somebody mentioned yesterday, hey, on a video I did, can you keep it simple? There were a lot of too many things in this one, and all I covered was the NASDAQ, not even the S&P or small caps, the NASDAQ, semis, a couple of the market-leading stocks in the NASDAQ, along with the SOXX, just the semiconductor ETF, which is a subsector. And, the NASDAQ, of course, is a tech-heavy index, over 50% tech, and then semis are a subsector of tech. And then I looped in TNX. And the reason is, and I said it in the reply there, right now, not at all points in time, but right now, at this point in time, that to me is probably one of, if not the most important thing that's going to determine where the stock market goes. With every tick up, again, I'll get to that in a second, in yields, you're going to see, and it has been cited as the cause for this drop, which before it happened said it would be if we got that. So meaning Treasury yields moving up. In other words, we've hit that point because they're pushing the previous highs and threatening to break out to multi-year highs, just at a time where the majority of market participants declared the end to rising rates, and now they realize, well, we might have called that one too early. The whole read my lip, no more taxes thing. All right, let's go into, after that, we'll look at gold, silver, just very brief updates. I got some charts out to you today. Bitcoin, and I had some questions on natural gas, and I'll cover crude oil as well. All right, long-term or intermediate term daily chart. So this is the only thing I've added since yesterday's update or yesterday's video was that trend line here, but I had that already for you on the 60-minute charts of both NQ and QQQ. So we broke above it, but met with selling all day and closed right back on it effectively. And most importantly, these are the levels I told you that I was really highlighting or focused on, is 365. So we failed to close. We tried to take it out intraday. You see a red candle means we closed back down well below it. Not huge, but we're down below it at 363.38 on the close today. And so that is another rejection there. Remember, we hit it yesterday, stopped cold, and that's where I mentioned, closing out my bounce trades, bounce alongs, earlier than my initial targets. Initial targets were this downtrend line right here. And again, for the reasons I cited, I'm not going to repeat everything. You can just go back to that video yesterday, and I'll get to Apple in a second. That was my indirect hedge. And so far worked out. Nothing big. Qs were down, 0.14% today, but they were down. And again, we'll take it one day at a time here. One day doesn't make a trend, but so far that is another. Yesterday was just really a back test, and today was a failed attempt to regain the 50. Remember, we took out the 50-day moving average, that yellow line right there, last week, traded down below it, and this is simply so far a back test with 2 days where the market's rallied up to, but failed to take back both that level and again the 365 former support right there, resistance there, now resistance. So that's what happened today, and I'm not going to give it a giant check mark for the bears, but I'll put that, give it a little bit of a check mark because that's what I wanted to see. I didn't want to see the markets take out and especially close much above 365 in the 50-day moving average. And again, even if they did, I told you this is where I'll short up to. Told you I'm going to hold on tight right now, but I'll short up to and then not above that downtrend line. So as I maintained, this was an objective short yesterday at 365 to get back in. That's what I did. and it will be also if we get up there, and it's not much further really. If you look at it, I'm just going to measure by grabbing the 365 level and going to the trend line if and when we get there, and there's some price resistance. We're only talking a little north of 2%. So let's just say, to me, that's an objective scaling zone if you're scaling in, or add if you want to get up to there. Problem is, if you hold off for that, is to level to add back shorts. Sometimes the market never gives you what you want. If everyone's looking for that, especially once a turn has come, what happens just when a rally starts to look good, that's often when they sell into it. So, all right, let's move on. Go to the 60-minute chart. There's that same downtrend line. Like I said, pretty much a breakout and a back test, maybe some bull flagging. We'll see. Again, NVIDIA reports after the close tomorrow, so we're going to trade all day tomorrow. The Qs will do what they do. And again, I'm going to get to NVIDIA in just a second here. So like I said, to me, it's worth starting to scale back into shorts here. And whether we do that or this, I'll still be or adding to shorts, but not above that level. And that's really where I'll be concerned about scaling out. You know, if NVIDIA really explodes somehow, well, did it once. If it does it again, you know, one thing to keep in mind that, remember, we're coming off a divergent high, and that's the case that I've made on the daily time frame here, and a lot of developments on the weekly time frame that say this very likely could mark the end of the rally off the October lows and the start of a new leg down. And right now, that's still my preferred scenario. Should NVIDIA give a little life to the semis and tech as a whole, and we go up, just keep in mind that any marginal new high, meaning slightly or relatively slightly, you know, not too much, a few percentage points above this previous divergent high, will simply extend the existing divergences that are already in place right now, right? So it would just bring the indicators up like that. And so that wouldn't change my long-term outlook. It's not what I want to see. And again, if you take out this line, I wouldn't want to ride a move out like that short, because there's no guarantee that if you do that marginal new high, you're going to get a reversal. So it's just something maybe at that time, stop out, maybe game it long. I'll let you know my thoughts if and when it happens. Right now, that's the you know, a potential scenario. There's a lot of possibilities in the market. It's not the one I favor. It's just something that I will point out that would certainly be a divergent high if we make a new high, marginal new high anytime soon. Weekly chart, let me zoom in here. This is a busy board. I have a lot on here, but the most important developments is the bearish PPO crossover recently on the daily, this weekly time frame, near overbought conditions. And if my read is correct, and this is just a bear market rally and new lows to come, then that's usually all it takes. In a bull market, you want to see a primary bull trend, just like this right here. You want to see negative divergence, ideally on the weekly time frame, especially that's been building for a long time. Then you get your sell signals, and that's what we had there. So, you know, we went down, hit that third target, bounced, and then you have these additional targets down here, and I'll most likely extend, add additional targets. In addition, this T4, which is that blue uptrend line, and or this 235 level. Blue trend line's gotten too far away now, so I'll have to add that as maybe T5 and keep the blue trend line as T4. Okay, just a quick look at the market leaders. Apple, still looking for, you know, much more downside in the coming months, looking for a pullback all the way to this bull market trend line here. Well, you have this more significant one off the 03 lows, and we're very close to that. And if we break that, that is the primary secular bull market uptrend line, Apple. That means big things to me if this trend line here, we'll color it up. Let's make a bright color, purple or something like that, if that one's taken out. But then I'll be targeting, have this other trend line here. It's still pretty long term, but not as long term. And that's has been since before Apple even topped, before anybody even knew there was or talk of a bear market or even a correction. That was that target then. And, you know, we worked our way down, and I think we'll continue to work our way down and get there. There's the blue uptrend line on a different board. This is kind of that clean board I have here. And so now let's just talk shorter term on Apple. So Apple, you know, was the, you know, case to short it or a case for Apple to drop was made recently with this break of this trend line, the back test, and we got the drop. And then I threw it out there as a bounce trade idea. So you have these targets, which I still maintain. T1 was already hit on the downside. Again, for a short, T2, T3, T4, based just off this 60-minute chart. Remember, weekly gives you much longer targets. Then I gave you these bounce targets, T1 and T2, and they still very well could get hit. You have the positive divergence. However, based on what I'm about to get to on the weekly charts, about an hour before the close today, I closed that out. Remember yesterday I said that was the one thing I had as a partial hedge to the QQ or NQ shorts. And I decided to book profits. Why did I do that? For a couple reasons. Number one, this is a different board. This is resistance, a zone right here of resistance right there up to about 177.30, and we hit that. You can see it's just this little area of consolidation, plus you had reactions from above there and reactions from below right there and there in the gap as well. So usually you get a whole lot more. When Apple puts in a 60-minute divergent low, positive divergence that is, that's usually off to the races to new highs. However, we're coming off a much larger divergent high, and that supersedes, if you will, the smaller positive divergence on the 60-minute chart. Now, my job is to give you analysis. I'll tell you what I do, what I'm doing. I don't mind that. Your job is to decide how to, whether to take that analysis, factor it into your trading or not. So if you're, nothing wrong. If you are long and you took the Apple long and posted out the other day as a bounce trade idea, you can still target these levels there. I just wanted to let you know that I'm pretty much effectively took the quick profits. It wasn't, believe me, it's not a very big trade. I just favoring that they might sell into this soon. In one of, which I'll get to in a minute, but but not the only reason, is again, the Treasury yields have yet to abate, and we're still pushing on those, multi-year highs on the 10-year. So there's Apple. The other ones to go over, I'm going to go through the daily chart real quick. Let me do the weekly for you. Here's Apple weekly. Remember, this was important to me. Again, I'm put a big emphasis or weighting on what's happening on the weekly charts. And that, because we just had this sell signal recently, this break of this primary uptrend line. Again, something I've gone over quite a bit on Apple. That was a sell signal, the bearish PPO crossover coming off the big negative divergence. I'm sorry, this is Microsoft here, guys. Let me get back. It's almost the same thing. Apple, there it is. So Apple broke down, and it's been playing out. And that, to me, was a very big and powerful and clear sell signal, just like the others in the past. Bearish PPO crossover, big negative divergence leading up to it, and all these other similar setups all resulted in drops of well into the double digits. Many of those, Apple lost a third or more of its value. You can see all that there, and I've covered that again many times. So I see in the coming months more downside in Apple. Next few days, who knows? Maybe we hit those near-term bounce targets that I gave you on the 60-minute chart. Maybe this is it. I have learned over the years, don't get greedy when you're trying to play a counter trend rally, especially early on if you have some pretty powerful sell signals. If you are going to do it, most typical swing traders, trend traders that aren't active, nimble traders, don't even bother. If you've got a good sell signal, sit tight, be patient, let it play out, ride out the counter trend bounces with your stops in place, based on whatever your trading plan was. So that's it. So I'm not going to get cute and try to see if I can milk out another 2%, maybe 5%. No, there's nothing to say Apple can't do that. But again, that was my maximum bounce target the other day when I gave you the trade idea. That was the minimum there. And we're close enough that, again, so boom, I'm out. Give you a couple more here, and then we'll move on to those other things. So Microsoft also recently, that was just my scenario arrow there, gave us a sell signal below this trend line right there. It's not the best defined trend line, but we are, just like Apple, coming off a very large, big negative divergent high on the weekly chart. And so I'm calling Microsoft down here to my next target, T2 right there. And then ultimately this yellow trend line right here, that would be my third long-term target, T3, and we'll just color it yellow so we know that's the trend line right there, right? Okay, so there's Microsoft. second largest component of the NASDAQ and S&P. There's Alphabet waiting to break down below this beautiful bearish rising wedge pattern on the weekly, confirmed or complete with negative divergence, just like you had there and the breakdown there. So looking for this. And that with the yellow trend line right here is a long-term primary uptrend line. That would be no bueno for Alphabet if that trend line goes, and I suspect it will go. So that's kind of long-term stuff. You know, if we do this now, then I'll be talking about that maybe 6 months, a year or two from now, if and when we get there. But if we get there, we start to break down, we could get there quick. Keep an eye on those primary trend lines. If we start to take those out, you could get that very powerful waterfall type selling if all these market leaders start to break those long-term trend lines. Here's Amazon just sitting right on the line right now. Big, fairly well-defined uptrend line on the weekly, poised to join Apple and Microsoft and Alphabet. Which ones? Let's see. Apple had the bearish PPO crossover already right there. Microsoft had it just recently right there. And Alphabet is poised to cross over as well. On any more downside, look at that. You had a little kiss and we're headed back down, poised to make the bearish crossover. The last high-level bearish PPO crossover that we had was right here. And didn't mark the day of the top, but it effectively, in percentage terms, the stock, it just went sideways for another month or two. Hardly made any gains, and you could have just simply shorted that that bearish PPO crossover, and then it was followed by this I don't know what that drop was, 40% or so. All right, so that's that. So there's another one. And if we get that bearish PPO crossover soon in the weekly, that's just one more check mark from my bearish case, especially if it comes with a break, solid break, and or especially a weekly close below that bearish rising wedge on the weekly time frame we're looking at here. Amazon, same thing. It's very close, and I'd put good money that it's going to happen soon. It appears imminent, just based on my read of these. Sometimes the lines kiss and don't cross, but pretty much when you see the PPO line, the blue line, starting to roll over and heading down, usually you cross. And here's a case where it looked like they were going to cross over, and it didn't. It kissed, it stayed low, but then you had the bullish crossover right there, and you got that big rally. Then you had a next bullish crossover right there, and you got this whole rally here. So that's it, guys. Wash, rinse, repeat. Just look at what happened after these bullish and bearish crossovers on the weekly, combined especially with breaks of support, such as trendline support and all this. So now that brings us to NVIDIA. Again, crowd favorite for the AI hype. And this is a stock that just has a history of very big gains on both the up and downtrend. So right now, everybody thinks NVIDIA is bulletproof, going to change the world with their leading AI technology for their chips and all that good stuff. And yeah, maybe so. But how much of that's priced into this move? These are the drops in the past after divergent highs on the weekly chart. Right there, you can see my divergent highs, nice and clean, right? 90%, 86%, 56%. I don't have this last one measured. That was a divergent high here. We were short the stock. It was dropped 67%. Okay, so that's it. So not a single divergent high going back for decades on this stock has resulted in a drop of less than 50% once that divergence finally manifests in the form of a trend reversal. These were targets that I had created back. You can see the little pop-up box all the way back in September, end of September 2021. So before anybody knew there was a bear market coming, before anybody, and I guarantee you 9, if not 10 out of 10 people here thought I was crazy calling this stock down even to that level. These two I added. I initially had these targets. This one I added on, no, that was also back in September. This one I created, so I added some additional targets right after we rolled over back in February, you can see, of 2022. And it played out perfectly. T1 was hit. There was a bounce. It doesn't look like a lot, double digit. T2 hit to the button, and that was, this is the reaction off T2, my second price target. And we had divergence at that time that gave us that drop of what I just told you, 70% or so right there. And The only difference now, we have divergence, but it's an extension of that same divergence that begins back here. And so therefore, we have about equal highs there on the indicators and higher highs in prices. And if you zoom in nice and tight, broke down last week, big red candle, there's your sell signal, back test last week at the highs, back testing again. And so based on this, somebody asked me and I made a reply, my guess, we already put in a divergent high. This is my chart, daily chart now in the video. So right here, we had negative divergence at that high. Maybe that's it. But just like the NASDAQ, if we pop, a post-earnings pop would be my most bullish scenario. Almost give you coin toss odds to it 50-50, meaning we take out whether it's in the after-hour session or they follow through in the regular session. But it is guaranteed right now, unless this thing just rockets up, 30, 40%. Any new high anytime soon will be a divergent, clearly be. There's no, these negative divergences aren't even close to being negated or taken out, meaning you'd have to move above the previous highs right there in the indicators. So we already put in divergent highs, so maybe that's all she wrote, or maybe we pop up, and either way, this is my next target on the daily, this uptrend line right here. I think this gap will be filled right here. And there's a lot of thin air. There's the gap, and it all comes in together. So from where we are now, or today's high, I'm just grabbing about where we were today, you're talking about a 32% drop in NVIDIA. But if we get that 32% drop, well, that's going to give us some clear sell signals, and we're going to roll off that back test of the trend line, and it's going to open the door, in my opinion, for a much larger drop. So there's my thoughts. Don't bet it too hard with NVIDIA reporting after the close tomorrow, because sometimes, we went over this with the other big market-leading FANG stocks, Apple, Microsoft, Alphabet, Amazon, even Netflix before they reported. Some of them dropped right away, some popped, and now they're fading. The initial post-earnings rally has been faded, some or all of it. And so this is the last of the big ones. This one's actually the the fifth largest component now in the NASDAQ 100. In fact, there's only, if my numbers are right here, I'm looking at my watch list to the right, there's only 5 companies, publicly traded companies, that are $1 trillion or more. Apple, remember, hit the $3 trillion club, and that was recently, I told you that was a kiss of death. And sure enough, it's no longer, down to 2.7. Anyways, NVIDIA is a 1.1 trillion company, and Meta is the next closest, and that's only a $726 billion company. So, and that's what Meta looks like. Meta already broke down. So see, a lot of these market leaders they've broken down. I might be beating a dead horse here, but what the takeaway is, I look for these divergent highs. I look for these clean uptrend line breaks. And these are the major trend changes, and so that looks about as good as it gets. And again, it's the majority of the market-leading stocks. So if NVIDIA craps out, whether it's immediately after earnings or a week or so after earnings, then that's just going to be another check mark. And as I showed you on Amazon and quite a few others, all they need is a little nudge to the downside. Another 5% or so will flip those. Give us those bearish PPO crossovers and or trendline breaks, support level breaks. So that's it. All right. So I covered the short term, near term, covered the FANGs. Other things I'm looking at, and we'll run through this a little faster. A few weeks ago, maybe 3-4 weeks ago, I said it's time to maybe start shorting the financials, or it was time to start shorting the financials. This XLF, the financial sector ETF, just like Intel and so many others that I've highlighted recently, we have these primary bear market downtrend lines. That was the top right there, end of the bull market and financials and many other things. Remember, there's a few stocks, but they're more the exception than the norm, like Apple, that have managed to make marginal new highs over their previous 2021 or early 2022 highs. The majority of other stocks and sectors are still below that, saying there's a good chance it's still a bear market rally. And so anyways, so when you see them rally into those downtrend lines, it's been a pretty big rejection in the financials. I won't go over each and every one because I've been covering these quite a bit lately. I've done quite a bit of coverage on the financials in the video. But remember, Visa yet to break, needs to break this trend line. That would be a big sell signal. That's a big old bearish rising wedge, complete with negative divergences. JP Morgan broke down today. and close below its primary uptrend line or big wedge. So that's a sell signal on the largest bank. Visa is just a little bit bigger in market cap, but that's a sell signal. Unless it can power on through there and make that a whipsaw, then that is a to me, very significant development in the financial sector, with JP Morgan now triggering an objective short entry sell signal, whatever you want to call it, 143.85 first support. Then and it's not an all-in moment on JPM, because you have that what I call BOD. That's a very, very, very good, well-defined level of support. I mean, very good, like almost a 10. So it could hit that, bounce up, but if and when it breaks that, that's an all-in moment, in my opinion. Doesn't mean your whole account. When I say an all-in moment, it just means a full position. If you were to allocate 10% of your portfolio to a JP Morgan short, that's your plan. Maybe you short 5%, of your portfolio today in it, and you wait for a break of 143.85 or so. Just wanted to point that one out. And then you have a lot of others that are just right on the line, like MasterCard, just waiting to break that primary uptrend line off the lows. Berkshire already broke down the other day, and nothing but red sticks since. Broke below the trend line there. Bank of America getting close. Bank of America has just been a dog. It's much closer to its multi-year lows right there than it is to to the previous highs. So something's wrong there, and that's one of the largest banks in the country and in the world. Wells Fargo already broke down. So I don't need to do them all. You can see a lot of the financials continue those bearish developments and levels that I highlighted a couple weeks ago, and over the last couple weeks, we're just getting more and more check marks here in this sector, especially with that breakdown in JPM today. So that's that. And I told you the regionals too a couple weeks ago. Time to start shorting those. They broke down this back test and back tested this trend line, ran into that resistance level, that right there. You had that key candle, and they've been rolling over. They put pressure on the small caps when they fall. The small caps have a high concentration. I'm talking about the Russell 2000 small cap index of regional banks. So, and of course, this also reflects on the economy. Banks are having problems, and it all going to loop back in. Again, it is super relevant at this point in time, probably more so at just about any point in time in recent history, to keep an eye on Treasury yields. There's just been no abatement in the 10-year. You can see I'm holding my crosshairs. This is that previous multi-year high in yields right there. This was, the market cheerleading and saying that Powell has won, his rate hikes are working, no more inflation. This is that kind of rut-row moment. In the worst case scenario, if we continue to see inflation heating up, and we have seen crude oil prices are still persistently high, even though we're short crude now, things like that, that's going to be no bueno for the market if you see yields continue to go up. But this is really starting to put the brakes on the housing market. I have the Zillow app on my phone, and it'll push little alerts. I'm getting price drops left and right lately, and new listings and all that. I think people are finally realizing, and there's no, we know, if you read the headlines, the 30-year mortgage just hit the highest rate in, I forget how many years. It was decades. And then I just read an article that the banks are starting to sour on jumbo mortgages. For those of you not familiar, conventional mortgage, I forget the dollar amount because it's been raised in recent years. But those will be backed by one of the federal agencies, like the Federal Home Loan or Mortgage Association, or one of those. And so banks have less risk, but then jumbos, the bank take on the risk. Jumbo mortgages over a certain amount. So if you're buying a $1 million, $2 million house and you're taking a mortgage out, you get a jumbo. And a few years back, I remember they were actually cheaper. They had better rates on jumbos than conventionals. But right now, the rates are significantly higher, and they've been increasing. That's saying the banks don't want to do those jumbos. They see problems. They don't want to take the risk right now of that. And so it's just everything breaking. It's this delayed impact of these rising rates. And again, there was a lot of bets made on the fact that rates were going to drop, and maybe they do. I've told you there's these divergences. We go to the 60-minute chart of IEF. If you don't have a TNX on your charting platform, the 10-year yield, or they might have a different symbol for it, you can look at IEF. That's the 10-year, 7 to 10-year Treasury bond ETF. And, I pointed out recently, we have these positive divergences. So we could rally, but we've had them here. We had positive divergences. We broke out, and it didn't go anywhere. And yields keep, going up, which keeps bringing the bond prices down. So what I think is going to happen, and I'm saying this lately, I favor a scenario where we actually do see sooner than later an abatement in yields coming back down. But I think it's going to be due to a flight to safety bid with the stock market dropping and institutions moving money from selling stocks and buying bonds. That's my guess. And then we could still get a rally here. But for whatever reason, if we don't, I'm not going to say it's a no-win situation, because there is this situation where the stock market rallies and then yields start going down, falling, and the bonds rally, and that is actually good for the stock market if it's done in orderly fashion, as long as it's not a flight to safety bid from the market collapsing. Okay, hopefully that'll make sense. However, we keep seeing the 10-year bond drop and yields keep going up, especially breaking out to new multi-year highs. That's making headlines. I can promise you there's not an institutional investor, a fund manager that manages even equities. They might never buy bonds in their portfolio. It might be an equity only. They know this. They're watching these yields. And you're not going to see the 10-year yield continue to climb, break out and climb, and not have an impact on the stock market. It would be highly unusual. Anything's possible, but it's highly improbable to see that. So there it is. I can't impress upon the importance of watching yields and trading to them as well. You'll see the market react if you get some big moves going forward. A big drop in the yields could be bullish again if it's for the right reasons, as I said earlier, or it may not. So try to understand what's going on in the stock market or any other cracks anywhere else at the time. All right, so that's it. You'll watch. I'll watch that and I'll let you know. Gold and silver. I told you recently, I usually will trade when I'm bullish on the metals. You're going to get more bang for your buck 9 times out of 10 trading silver or GDX versus gold. Gold, is they will follow it. Silver and GDX will follow gold, but they just tend to move up and down in percentage terms more. So if you're bullish on gold, you can buy gold. Sometimes it will outperform, but usually silver is going to do better on a good day or a good trend, and so will GDX, and vice versa if you're bearish and you're short. So there's still the potential. You have this positive divergence here. Divergent low would break out of the minor trend line, and as I told you today, silver hit that first target right there, and this is what I gave you the other day. We were right here. It was, what was it, Friday? It was just recently. I think it was Friday. I gave you these trade ideas in gold, silver, and GDX, and boom, right to the button. And as I got it out to you this morning when we first hit it, I said you're likely to get a reaction there. Well, there's a reaction, folks. So I define a reaction as a pause, which is a consolidation, or a pullback when you're going up into a resistance level, and that's it. So we traded the entire day. All these candles, 1, 2, 3, 4, 5 candles. There's 6.5 hours in a trading day, and there's 5 hours worth of trades right at the majority of the trading day at that 21.49 level. To the button. There's high on 21.49 if you see the pop-up box. So that's it. That's a reaction. PPO is poised to cross over, and I'm not as optimistic as I was a few days ago of us hitting that, but there's still possibilities. So as I said, it's simple stuff. I like doing these situations, tighten up stops. That allows for this if we're going to get it. And if not, and if they turn around and drop down, then guess what? You gave back a minimal amount of profit. So that's that. And GDX, I think it's moved up today too. Broke out of that little bullish falling wedge, and it's up not much the last couple of days, 2% or so. Almost done here. I might as well show you the euro, because the euro has a big impact on where the gold and silver go. We keep just like treasury bonds, we keep putting in these divergent lows, and we just can't. It's a failure to launch, but the divergences are getting bigger and bigger. And remember, it's not just gold and silver that have a positive, very tight positive correlation with this, meaning euro goes up, they go down. Lately, today, you didn't see that. You saw the rally. We got hit our target in silver, but this is sort of a red flag, and it's also a red flag for the stock market, because the stock market, as I've showed you many times in recent weeks and in the past, has a very strong, and has, at least for the last couple of years, a very strong correlation, meaning they both go up and down together. So this today, we have these divergences. They may play out, and if they do, that'll probably coincide with a stock market rally and a rally in gold and silver. But so far, we keep getting these divergent lows, keep getting sold into, and yeah, that's it. Just wanted to point that out. And we're at some support too. So, but bigger picture, remember, bigger picture, and that's where I'm speaking to. It's just on a 60-minute time frame. But this is what I've covered in recent weeks and months. From a longer term perspective, this is big negative divergence here, extreme overbought on the RSI, and this could send the euro down quite a bit. And we just broke this primary uptrend line right here recently. So we're fresh off the breakdown. It's just a matter, do we have a little kickback rally from the 60s, or do we keep moving lower and burn through those 60-minute divergences? I don't know, but I'm kind of leaning toward, at least like I said, I've given you my scenarios for the stock market. We can see a disconnect here. Sometimes you get a disconnect between the euro and the stock market. Usually it'll last for maybe a week or 2, 3 weeks. Then you have a reversion to the mean where one comes down and the other goes up, or vice versa. They come back in. All right. 2 more things here. A couple more Bitcoin. Somebody asked today an update. I haven't covered it a lot lately, but back here I was pointing out this divergent high, i.e. big negative divergence, and expected it to walk its way lower. And we've been stepping lower. There was that first support I had, 18.43, and this one here at $17. You had a reaction here. I've had that line on here for a long time. And that is 1, 2, 3 days trading on there. So that's support. Bottom line is, it looks to me, looking at this chart, based on the scope of these divergences, there's more downside to come, quite a bit more in Bitcoin. But you need to take out the $17 level with conviction to do it. So that's your next sell signal there if 17 is taken out. Natural gas, somebody asked, I don't have a very strong, it's still in that sloppy trading range. From a longer term perspective, it has that big divergence on the daily time frame right there, and even the weekly time frame, but we're still in that trading range right there that we've been in. It looks to me like a basing pattern, and once we clearly break above it, start to move away, natural gas will likely run. It could fall apart. It's possible, but when you look at the price of natural gas, we're closer to multi-decade lows than multi-decade highs, and we're still in an inflationary environment. So I favor upside. It's just in the near term. My reply to that question, this is what the chart looks like. I don't see a whole lot here. You've got maybe a little positive divergence going there right now, and so if I had to take a best guess here, if you can come down to 664. Buy it there, great. Or it might even not even get all the way down there, and this 60-minute divergent low will probably play out for a bounce soon. And then you could see here's a resistance level you might want to target. But there's all my levels, and boom. And I think I said last time we hit T2, you need to take out T2 to open the door to really get things going, and just haven't been able to do that yet. So that's it. So I don't have a very, very strong opinion near term, but my guess is the RR is starting to look attractive because of the 60-minute divergent low right now for at least a near-term, short-term swing trade, maybe more. And then last but not least, we'll wrap this video up. USO crude oil, that one was thrown out as a short trade idea here shortly before we even broke down. Hit my first target the other day, and it was, still is, an objective short here today on this kickback. I've added this, only thing I've added to this chart since I got out to you is this minor downtrend line right now. And so that's what I think it'll have, another leg down, hit my second target, hit my third target, which I'm still maintaining. And then at that point, I'll share my thoughts. But I'll probably most likely close this trade out officially on the site and personally if and when that went. All right, so that's that. I believe that's everything I wanted to cover. I will watch NVIDIA again. Don't put too much into the initial reaction after earnings. It usually takes a while. The conference call comes out. Is there any guidance? What do they say? And then most important is how it trades the following day. That'll be Thursday after the market opens and all the players are on the field with the liquidity that you get in the regular session. And so it always takes not always, but usually takes a day or two for the dust to settle after a company reports. So that'll be a big one. Make or break it for the semis for NVIDIA. I gave you a level to re-short the semis. I told you and first somebody on the site in response to one of the comment sections, and then I updated it and got it out to everybody the other day that I expected a bounce in the semis. Good time to cover them. We're at this trend line right here. We hit it the other day. Very significant trend line. We had positive divergence right here on the PPO. So anyways, that's the bounce. But as I said, and you can see it here also on the daily, this is a big resistance level. And we came close today. So if we get there tomorrow or Thursday after NVIDIA, that would be an objective area to add back some shorts or up to, but maybe hold off if we go much above 507, or on a break. We have the primary uptrend line right here. That's the one I was just talking about a minute ago. What I'm going to do right now is tweak this trend line. Why did I do that? Well, I had that slight violation there, and so now I captured the bottom of that candle, and it comes in perfectly with that candle right there, if you can see it. This candle's April 27th. There's a long shadow at the bottom of the candle, i.e. a tail, and now I've caught that one, and it comes back to the October lows. So I have 3 clean, distinct reactions. 1, 2, another reaction there, and then this one here, so really 4. And that's the big one. So set a price alert if you don't have one, and that's the quote-unquote all-in moment for the semis when that trend line goes. All right, so you can either short on a bounce to resistance and or on a break below the primary uptrend line. I'm going to wrap it up here and get this one out to you, and we'll pick it up tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.